So you've decided to start investing, and that's a great move. But before you put your money anywhere, you need to know something most people learn too late. It's not just about what you invest in. It's about what mistakes you avoid. The truth is, many people who invest still end up broke, not because they didn't try, but because they made avoidable, destructive mistakes that quietly killed their wealth. In this video, I'm going to walk you through the 3 most common investing mistakes that keep people poor, and exactly how to avoid them. This isn't theory. This is what keeps people stuck for years. Let's make sure that's not you. Mistake number 1, chasing hype and ignoring fundamentals. Let's start with the most obvious and the most dangerous. You hear about a stock that can't lose. A friend made 300% on some crypto you've never heard of. Reddit's exploding with some meme coin, and you feel like you're missing out. So you buy. You get in. You're excited. And then crash. This is the classic fear of missing out, FOMO. And it's killed more portfolios than any recession ever has. Here's the hard truth. If you don't understand why you're investing in something, you're not investing. You're gambling. Sure, some people get lucky, but most people who chase hype lose money. Slowly, painfully, and publicly. They buy high. They panic when it drops. They sell low. They repeat. Meanwhile, someone else is quietly investing in index funds and winning big over the long term. The solution: stick to what you understand. Invest in proven, diversified assets like ETFs. Build a simple, boring portfolio that matches your goals. You don't need to beat the market. You just need to not lose to yourself. The real wealth is built not by chasing fast wins, but by staying consistent while others are distracted. Mistake number 2, timing the market. Instead of time in the market, everyone wants to buy low and sell high. And in theory, that's how it should work. But in real life, most people do the opposite. They try to predict crashes. They panic when the market dips. They hold cash just in case. Then they miss the recovery, miss the growth, and miss the entire point of long-term investing. Here's a painful stat. If you missed just the 10 best days in the stock market over the last 20 years, your returns would be cut almost in half. That's how damaging trying to time the market really is. Now let's compare 2 people. Sarah invests $500 every month, no matter what. John tries to wait for the right time, jumping in and out. After 10 years, Sarah ends up with way more money, not because she's smarter, but because she stayed invested. The solution: you don't need to time the market. You need to spend time in the market. Automate your investments. Put money in every week or month, regardless of what the headlines say. Ignore the noise. Stick to the plan. Let time do the work. Mistake number 3, investing without a plan, aka no strategy. This one is huge and invisible. Most people think investing means opening a brokerage account and randomly buying things they've heard about. They don't have a goal. They don't know how much risk they're taking. They don't know when they'll need the money. They don't know how much they're trying to build. And without that foundation, everything else falls apart. It's like trying to build a house without a blueprint. You can buy great materials, but if you don't know what you're building, it's going to collapse. The solution: before you invest, ask yourself 3 simple questions. What is the goal? Retirement? Passive income? Buying a house? Freedom? When will I need the money? 5 years? 20 years? Never? How much risk can I handle? Can I watch my investments drop 30% and still sleep at night? Once you answer these, you can build a strategy that fits. Maybe it's 80% in VOO and 20% in SCHD. Maybe it's 50-50 between stocks and bonds. Maybe it's aggressive growth now, then more conservative later. Whatever it is, make it intentional. Because people who invest without a plan tend to panic, overtrade, or quit too early. People with a plan? They build wealth, even through market crashes. Bonus mistake: ignoring fees, taxes, and costs. This one's sneaky. Let's say you invest in a mutual fund that charges a 1% annual fee. That doesn't sound like much, right? But over 30 years, that 1% can eat up hundreds of thousands of dollars in lost gains. Same with taxes. If you sell too often or hold the wrong assets in the wrong accounts, you'll owe a lot more than you expect. The solution: choose low-cost index ETFs like VOO, SCHD, or VT. Use tax-advantaged accounts like Roth IRA or 401k. Don't overtrade. Understand capital gains and dividend tax rules. The less you pay in fees and taxes, the more money stays with you. So how do you avoid these mistakes? Here's your checklist. Stop chasing hype. Invest in what you understand. Stop timing the market. Invest consistently, no matter what. Build a plan. Know your goal, time horizon, and risk tolerance. Minimize costs. Low fees, smart taxes, simple strategies. That's it. Wealth is not complicated, but it requires you to stop doing what everyone else is doing. Everyone else is panicking, buying hype, quitting too early, and paying too much. You'll be consistent, patient, and focused. And that's what actually builds wealth. Final thoughts. If you're just starting, it's okay to feel overwhelmed. What matters is that you're learning. You're thinking. You're taking control. Mistakes are part of the journey, but they don't have to be yours. Now you know what to avoid. Now you know how to invest smarter. Don't worry about being perfect. Just be clear, be consistent, and be in it for the long game. If this video helped, hit the like button, leave a comment with what mistake you've learned from, and don't forget to subscribe for more simple investing content every week. This is not financial advice. Always do your own research before making any investment decisions.